Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They're commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The 2024 election is now, well, at least almost, in the books, and the one thing we know is that there is a new sheriff in town, a sheriff that believes full-throatedly that he has been given an unquestionable mandate to clean up Dodge. The problem is that a little less than half of the town doesn't believe there was a problem, are completely against him being sheriff, and don't believe in his way of doing things. I suppose it is, as the Chinese aptly lament, may you live in interesting times. The question both sides of the town are asking are, will this sheriff be successful? What type of town will we become? Will I want to still live here when he is finished? I suspect, like this early American metaphor, we won't know until the shootout is finally over at the OK Corral. As such, I like to discuss the outline shown here. The first indications of what may be ahead is that the concerning spike in U.S. sovereign risk has shockingly collapsed with the election. The financial markets are showing their relief in a very visible way. Credit default swap pricing stunningly shows, since Trump's red sweep, that the market was using short-dated U.S. sovereign credit default swaps to hedge the possibilities of the Democrats and the Harris-Walz win. Clearly, the financial markets had a preference for who would win, or are suggesting that any path may be better than the one we're on. The election results are still being interpreted in any number of ways. Exit polls showed a whopping 72% of Americans understood as they exit the polls that their country was on the wrong path. What is clear is that the issue with the town folks was not immigration, not crime, not equity, not abortion, not climate change, not guns. In the end, the only thing that mattered to them was inflation. The town folk only saw the cumulative and continuing rise of the impact of inflation over the last 4 years, and not the fact that the rate of rise was falling. Wall Street's and Washington's messages were misaligned. Let's first start with quickly recapping what our new sheriff promised the townfolk. Promises made, but can those promises be kept? The old-timers cynically believe that political campaign promises are never kept. A little less than half of the townfolk hope and pray they won't be. All the others say they better be, or there will be hell to pay at the next midterm election. The number one promise made was to fix the mass illegal immigration problem, believed to be somewhere from 15 to 25 million immigrants. This will mean, potentially, a very disruptive process in primarily major U.S. cities. The focus will include securing the border, mass deportation, a war with the Mexican cartels, rounding up immigrant criminals, gangs, subversives, sex traffickers, and drugs. This is not going to be well supported at all by those who don't even believe there is a problem. The promise of 10% in tariffs or higher was a big part of the campaign, which will now involve direct conflict with Mexico, China, and the EU. The markets see this as potentially reigniting a smoldering inflation problem. The often spouted campaign rhetoric of drill baby drill now flies completely in the face of the cornerstone priority over the last 4 years of fighting climate change and implementing policies of sustainable energy. We can expect a massive cut in federal regulations regarding oil and natural gas exploration, reopening of ANWR, removal of the U.S. from the Paris Accord, revitalization of the U.S. energy and fracking complex to achieve the U.S. becoming energy independent and a net global exporter of energy. We can also expect tax cuts and rollback of regulations limiting job creation. Deregulation implemented by Trump 45, but taken out by the last administration. We're going to be back on again. We're in an on-again, off-again world of regulations that is tough to run a small business in, any business in. The net of all these campaign promises is shown here, which I chronicled earlier during the campaign. Extend the 2007 Trump tax cuts will be $5.3 trillion, exempt overtime income, $2 trillion, end taxation of Social Security benefits, $1.3 trillion, exempt tip income, $300 billion, and exempt income of firemen, policemen, military, and veterans at $2.5 trillion. All commitments that he has made on the campaign trail. It is hard to believe these will get through Congress, but they are on the table of promises made, promises kept. Social programs. We also have a draft of social program changes ranging from the elimination of the Federal Department of Education to purging DEI programs in colleges and schools to stopping transgender competition. What should be obvious from this recap of stated changes supported by the majority of the popular vote and the red wave is that people want and demand change. They are afraid the American way of life is disappearing, and they are desperate to keep the American dream alive for them and their families. What we are talking here are changes that border on what can only be termed a revolution. Changes to this degree come with unprecedented turmoil. Can these sorts of changes actually be implemented? What realistically should we expect, whether you support them or not? That's what we're talking about. Being realistic. The organization required is itself alone a massive impediment to achieving something like this. However, when we look at Project 2025, which is a presidential transition plan, I didn't say Trump's, but a presidential plan, we see some massive work that has been underway over the last 4 years by a consortium of approximately 50 conservative organizations to prepare for this degree of change. Trump has been adamant that he has not even read this plan, but that is actually irrelevant. The plan will deliver to his transition team over 3,000 vetted and trained candidates, ready to fill the political appointments required to be filled by a new administration. These candidates are certified as committed to Trump's plans and leadership. Apparently, they're trained in what they will face as obstacles by what is referred to as the deep state, which fought everything Trump in his first term. The expectant deep state is 98% Democrat by political preference and personal voting. There can be little doubt Trump's transition team will fully endorse much, if not all, of this ready-made invasion landing force. Just maybe, there's a chance of Trump actually pulling off some of this mountain of change since he has swept control of Congress also. Based on this, and Trump having already been president with a raft of experience from his first term, and 4 years of then sitting on the sidelines in an attempt to become Trump 47, he also has a full slate of loyal, competent, and ready cabinet choices available on day one. This is starting to look interesting, maybe even possible. What might we therefore expect? It looks like the following are real possibilities. Tax cuts, a full extension of 2017 tax cuts that expire at the end of 2025, likely including reinstatement of some expired business investment incentives, likely some modest additional tax cuts to accommodate Trump's campaign proposals. Expect these proposals to be scaled down, no doubt, but would only cut taxes by a few tenths of a percent of GDP, primarily focused on individual income taxes and not corporate. Fiscal spending, with the Republican sweep, federal spending growth will likely rise somewhat, particularly on defense. Regulations, likely a lighter touch approach, particularly with regard to energy, financial, and labor policies, while some aspects of antitrust policy might ease slightly. Expect scrutiny of the tech sector, however, to continue. Tariffs. We can expect Trump to impose tariffs on imports from China that average an additional 20 points. Therefore, the 10 to 20% across-the-board tariff that Trump has proposed is very possible, with a 40% chance it will be implemented. Expect auto tariffs to come into focus on auto imports from the EU, though this could be applied more broadly. Estimates are that this combination of tariff policies would provide a one-time boost to core PCE, inflation at peaks at 30 to 40 basis points, and a modest drag on GDP. Trump tariffs could derail the Fed cutting cycle. The Fed is likely to pause the cutting cycle if large tariff increases are announced, assuming the economy is still on solid footing. Immigration. Expect reduced immigration to around 750,000 per year, slightly below the pre-pandemic trend. They're not going to stop it completely. I don't think that's the intent. They just want to make it legally done. Europe. Expect Trump's policy agenda to affect the European economic outlook via several channels. First, renewed trade tensions are likely to weigh materially on growth. While the proposed 10% across-the-board tariff is a clear risk, expectations are that Trump imposes a more limited set of tariffs on European economies, targeting primarily auto exports. Second, Trump's re-election will likely entail renewed defense spending and security pressures for Europe. Any resulting growth boost, however, is likely to be limited by modest military spending multipliers in Europe, upward pressure on long-term yields from higher deficits, and negative confidence effects from elevated geopolitical risk. Third, expect small net spillovers from the shifts in U.S. macro policy and financial conditions. Taken together, analysis points to a 0.5 hit to real GDP in the euro area, ranging from 0.6 in Germany to 0.3 in Italy, with a moderate 0.4 hit to the UK. Expect the bulk of the growth hit to materialize between 2021 Q1 and Q4. What have the financial markets' reaction been so far to all this? Actually, pretty good so far at least. Markets are signaling expectations of higher growth, lower volatility, as the chart here shows already, and inflation, and a revitalized economy for all Americans. Trump's election drove the largest single-day increase in the U.S. dollar in more than 2 years, and a third largest in the last decade. This is a vote of confidence in U.S. leadership internationally and in the dollar as the world's reserve currency. That's a big deal, the dollar itself. I'll get back to that later. The Russell 2000, an index of small capitalization stocks, also rose by the most in 2 years due to investor expectations that the Trump economy will disproportionately benefit smaller business. An exchange-traded fund that tracks the Russell 2000 index saw its largest single-day inflow in 17 years. The rally in equities was particularly unusual, given that interest rates also moved higher. The combination of the steepening yield curve, stable inflation expectations, and the rise in stocks indicates that markets expect the Trump agenda to foster non-inflationary growth that will drive private investments. Even amid the expected pro-growth agenda and the associated increased demand for energy, the price of oil fell. Energy stocks rallied at the same time, signaling expectations of more energy production and geopolitical stability. These are important signals that we really do need to pay attention. The markets are optimistic here, and they're putting their money behind it. What is clear and hanging over everything, however, is what can best be described as some boundary condition realities. Inflation risk will mount further from here given likely tariffs and fiscal stimulus. Moreover, the backdrop is already one where central banks are easing policy, while growth data is surprising on the upside. So this is a prominent concern that could prompt a more hawkish reaction from the Fed. Deutsche Bank has warned about inflation risk in recent months, and since the bank's most recent piece in September, the 2-year U.S. inflation swap has risen nearly 50 basis points. Fiscal constraints. The financial context is very different to Trump's first victory in 2016. Fiscal constraints are tighter given higher Treasury yields and a higher federal debt, while asset valuations are much higher as well. Debt ceiling, assuming we get unified government, which Polymarket places at 99%, the risk of a debt ceiling crisis has frankly just collapsed, at least for the next 2 years. A political window, U.S. policies is very volatile. In 9 of the last 10 presidential midterm elections, at least one of the White House, Senate, or House of Representatives has changed control. So it's entirely plausible and likely the political landscape changes quicker than many expect today, and certainly should be a change seen at the midterm election. Likely. Well, we'll see. If all this so far is leaving you a little confused, a little concerned, and overall perplexed, you're not alone among most of the town folks. Maybe we need to stand back for a second and see things from Trump's perspective. Frankly, it is currently the only thing that truly matters until the dust clears. President Ronald Reagan got it, and so did Donald Trump, sort of, in his first term. There is a major difference between government fiscal investment and government fiscal spending. Both will potentially grow GDP, but the former is in a powerful way, the latter through chronic deficits. The Reagan economic miracle, for those who recall, took time and cost him his first term's midterm elections, but it began to work and secured his second term. What was the fiscal investment that created the miracle? It was about investment in the people that power the economy, not giving them money, investing in them. He built it on 2 cornerstones to empower fiscal investment: reduce strangling regulations and reduce corporate and personal taxes. That's like leading into a punch. You're up to your ears in debt, but you should reduce corporate and personal taxes. Trump did both of these in his first term to a large degree over an anything but Trump opposing Congress. What Reagan got with a supporting Congress was the realization that U.S. government has grown to the point that it was now the problem. Government control, regulations, restrictions, and taxation was strangling the U.S. engine. Reagan's understanding of the unorthodox Lafleur curve guided his thinking and is Trump's. An investment is different than simply spending of tax money. Fiscal spending is the allocation of tax money in the form of redistribution of wealth. Today, tax money and deficit spending is allocated in a fashion that goes towards consumer consumption in the form of transfer payments. There is no investment, but rather the consumption of money. Fiscal investment is not about redistribution, but rather allowing those who have the money to keep it and use it to produce personal wealth. Their success, let's call it personal greed, ambition, or even vision, is the only proven sustainable factor to create investment and wealth. That wealth grows taxation, increases jobs and wages. This in turn propels independence, positive sentiment, risk-taking, and consumer confidence. We go to a virtuous upward cycle from a downward economic spiral. This is pretty basic and fundamental. It is not theoretical and has been proven to work. This may all sound academic, but it isn't. It is really why real democracy and real capitalism works. We've been living under something that is best described as creditism and as anything but capitalism. Capitalism is fundamentally about savings being invested into productive assets, which increase the overall standard of living. Creditism is about credit being created that is used for consumption. In a country like the U.S. that now consumes much more than it produces, you're automatically trapped into a downward economic spiral. There is only one way out, and that is fiscal investment, not fiscal spending. The problem in America is the growth in jobs is in government and consumer consumption services. Jobs need to be created in higher paying production of goods and services that are exportable. Today, that is the domain of China, since the U.S. relinquished it to the globalists and exported 54,000 U.S. factories to China when they entered the World Trade Organization in 2002. Trump's fiscal investment is about using tariffs to incent, or more aptly force, jobs and factories back into the U.S. That's a big gamble, but that's the gamble that he looks like he wants to take. Trump's economic advisor, Scott Bessent, who is being considered for Treasury Secretary, is already actually working on this. Bessent favors a T+X tax tariff plan that gives global firms, say, 2 years to build factories in the U.S. to avoid sanctions, reducing most of their direct inflation impact, but getting all the capex, supply side, and trade deficits, narrowing gains. Samsung immediately said this is what they plan to do. That might mean new economic models are needed for U.S. tariffs. If economists want to model a world as it is rather than as they or their models want it to be, Trump's tariffs will initially likely still elevate prices, but if successful in fostering a reshoring renaissance, it may be the only way out of the death spiral that the U.S. is obviously in. This is the only solution, frankly, available to America unless we just want to follow the path to doomsday. It is no doubt a calculated gamble, but maybe the only one left on the table for a country clearly headed down a road towards a dismal and inevitable debt crisis. We are told that we are a service economy, which is true. What we are not told is an economy can't survive unless it exports those services to a greater degree than it imports its goods. The central issue in America is simple. We consume more than we produce and have for decades. It mirrors our exploding trade deficit and fiscal deficits. Trump has been extremely clear on a campaign for those actually listening on tariffs. And I quote him, "To me, the most beautiful word in the dictionary is tariffs." Trump said in an interview here to the editor-in-chief of Bloomberg News in October, and he also said, "It's my favorite word." This is pretty strong language. He's trying to tell us something. He added at the time, I quote, "You see these empty, old, beautiful steel mills and factories that are empty and falling down," referring to facilities that used to make goods in the United States. "We're going to bring the companies back. We're going to lower taxes for companies that are going to make their products in the U.S., and we're going to protect those companies with strong tariffs." I think he's let the cat out of the bag. That's what this is about. If Trump is even mildly correct, he could unleash and tap into the animal spirits of corporate deal-making. Trump and his economic advisors are well aware that mergers and acquisition activity relative to GDP is well below trend levels, leaving room for some serious acceleration before it becomes even credit negative. Further, given the levels of debt-funded M&A initially might see a more gradual uptick versus strategic activity, accelerating appreciably as we get closer to the end of the cutting cycle. Trump is also acutely aware that the dramatic growth in private equity or private credit or shadow banking has been a major theme in credit markets for decades now. The growth has been massive and not yet been fully tapped. This could propel an unlimited amount of investment. Currently, it has prompted talks about greater regulatory oversight and scrutiny to control it. This is exactly where Trump's team can make some strategic moves and are looking at that. The expected focus on deregulation in Trump's second term dampens this prospect, which bodes well for the continued growth of private credit, maybe even exploding. There may be no better time to take on China than now, as foreign investment is plunging and has went negative for the first time ever, or at least since it came onto the global export scene. There may be just a chance that Trump 2.0 may pull this off. So what can we conclude? The Trump trade may actually be about the Trump card that Trump now holds in his hands. He has a Trump card. China needs U.S. consumers. Without the U.S. consumer, nobody has exports. We have the Trump card. If he can pull it off, the future of America depends on it. What this is about is actually, if you think about it, reprivatization of the U.S. economy. While markets expect a reinvigorated American economy, the Biden administration's mismanagement has created serious challenges that the new Trump administration will need to overcome. It needs to stop false and unproductive economic growth. I've written continuously about that. Economic growth has been propped up by out-of-control federal deficit, which hit 7% of gross domestic product last year. Trump has a mandate to reprivatize the U.S. economy through deregulation and tax reform to spur the supply-side growth that he delivered in his first term. That will be essential to restarting the American growth engine, reducing inflationary pressures, and addressing the debt burden from 4 years of reckless spending. He needs to stop the distortion of capital allocation. The U.S. economy also faces consequences of the Biden administration's distortion of capital allocation. U.S. competitiveness has been weakened by destructive energy policies and the channeling of investment towards chaotic energy transition and semiconductor fabrication plants subjected to government mandates that render them uneconomic. Trump will deliver a renaissance, or could deliver a renaissance, in American energy investment and ensure the trade is free and fair, supporting long-term U.S. competitiveness. Allowing the private sector rather than the government to allocate capital is crucial to growth. The U.S. must reform the Inflation Reduction Act's distortionary incentives that encourage unproductive investment, which has to be sustained by a lifetime of subsidies. Overhauling the regulatory and supervisory environment will encourage more lending and reinvigorate the banks. We need to restore faith in the U.S. economy and the dollar. Trump must also address government borrowing. U.S. interest expense exceeds the defense budget. Treasury Secretary Janet Yellen has distorted Treasury markets by borrowing more than $1 trillion in more expensive shorter-term debt compared with historical norms. Terming out that debt in favor of a more orthodox borrowing profile may increase longer-term interest rates and will need to be deftly handled. The only way to return to prudent borrowing strategy without upsetting financial markets is restoring investors' faith in the economy and preserving the dollar's global role. Let me emphasize that. Without restoring faith in the U.S. dollar, Trump can never expect to beat inflation, nor any president for that matter. The failure of Bidenomics is clear. But Trump has turned around the economy before, and he is ready to do it again. 23 Nobel laureates might not understand this, but the financial markets have clearly spoken. And all I can say is God bless Trump. As an American, whether you're Democrat or Republican, you need to pray that he pulls off what is going to be potentially the Trump miracle. As I always remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems, until such time as no one will take that money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis. I'd like to take a moment as a reminder, do not trade from any of these slides. They're for educational and discussion purposes only. As negative as these comments often are, there's actually seldom been a better time for investing. However, it requires careful analysis and not necessarily following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed professional financial advisor. So until we talk again, may 2024 turn out to be an outstanding investment year for you and your family, and I sincerely thank you for listening.